Someone watching this right now is on the edge of selling their silver. I've seen the comments. I know exactly where their head is at. They watched the move from $34 to $121. They held through February. They held through early March. And now, staring at $69.51 on a Monday morning while every headline screams capitulation, they're wondering if holding any longer is just stubbornness. I need to catch that person before they hit sell, not to convince them emotionally, but to force clarity on what they're actually doing, and more importantly, who they're selling to. Because once you understand the other side of that trade, your entire interpretation of this market shifts. Today is Monday, March 23, 2026. The paper price of silver is $69.51. Gold is at $4,426.70. Both are accurate. Both are being used to frame the current state of the precious metals bull market. But neither is telling the real story. The real story is buried in vault data, in depository reports, in registered inventory levels that the financial media barely touches. That story can be summarized in one line. The vault is still draining, and understanding what that means in practical, mathematical, and structural terms is the difference between reading this correction correctly or completely misreading it. Drop one word in the comments right now, holding or sold. I want to see exactly where you stand. Here are the surface numbers. Silver at $69.51, gold at $4,426.70, the gold to silver ratio at 66 to 1, the highest level in this entire bull cycle. Silver is down over 14% in just 1 week. Gold just posted its worst weekly drop since September 2011. This is now the third straight week of losses for silver after peaking at $121 in January. The mainstream narrative is already writing the end of the bull market. That's the paper story. Now here's the physical reality. The COMEX combined silver vault, as of the March 20th report reflecting March 19th activity, sits at 332,695,254 ounces. 2 weeks earlier, it held 344 million. The week before that, 349 million. In just 3 weeks, while price dropped and retail accounts everywhere announced exits, the vault lost roughly 16 million ounces. 16 million ounces left during the most aggressive phase of the sell-off. That silver didn't disappear. It moved, and once it leaves the COMEX system into private storage, industrial use, or institutional vaults disconnected from the exchange, it rarely returns. Price is falling while metal is leaving. That's not a contradiction, it's the entire signal. Understanding how those two things happen together and what that means is the whole point of this discussion. Let's go line by line through the March 19th depository activity so you see this isn't theory. This is physical metal moving with a record. Brinks reported 616,162 ounces withdrawn from eligible inventory. That metal physically exited their vault. Manfra, Tordella, and Brooks reported 1,413,221 ounces removed, gone from the system. Delaware reported 969 ounces out. CNA added 40,890 ounces, the only meaningful inflow, and it was insignificant compared to the outflows. A net movement that day, negative 1,989,463 ounces. Nearly 2 million ounces left in a single session? Oh. And that happened while price was dropping and headlines were filled with panic language? Two groups created that outcome. Paper sellers pushed price down. Physical buyers took the metal. And those groups are completely different. They don't think the same, act the same, or operate on the same timeline. Paper sellers are reacting to momentum breaking and margin pressure. Physical buyers are reacting to shrinking supply. The vault tells them something the chart doesn't. Silver is getting harder to obtain. The delivery pool is tightening. And the price they're paying now won't look the same when the next delivery cycle hits. The $69 price reflects the seller. The 2 million ounce withdrawals reflect the buyer's response. Before breaking down the drivers of this correction, I want to anchor one external perspective, not from a metals channel, but from mainstream finance. On March 20th, at peak bearish sentiment, Arthur Parrish from SP Angels said clearly on CNBC that the current selling is coming from generalist funds. Yes. Systematic traders, and momentum-driven retail. He described them as non-committed participants. Then he made a key point there. Exit is likely necessary for the next leg higher. Think about that. On a day the chart looked weak, a professional analyst said the sell-off is a clearing process, not a breakdown. The market is shedding weak hands. Momentum money is leaving. What remains is stronger ownership. The tourists are exiting. Structural buyers are staying. That's the framework.
Ow.
The three forces behind this correction. First, the Federal Reserve. The FOMC signaled rates staying higher for longer. A large chunk of institutional money entered metals expecting rate cuts. When that didn't happen on schedule, their thesis broke. So they exited. Not because silver failed, but because their macro assumption did. Second, the Iran conflict pushing oil toward $110. That creates a paradox. Higher oil supports inflation, which should help metals, but it also drives risk-off behavior and dollar demand. Two opposing forces acting at once. That's why price dropped, while physical demand stayed strong. Third, and most important, is leverage unwinding. Silver's run from $34 to $121 brought in momentum money. Funds, retail, trend followers, all chasing performance. When momentum reversed, they didn't reassess, they exited. Systematic funds follow rules.